This episode is sponsored by Lloyd's Register, a trusted partner in the evolving energy landscape, and EIC Global Platinum Partner. As the world works towards net zero, traditional fuels like oil and gas will remain essential in meeting global energy demands. Lloyd's Register supports operators across the energy spectrum, helping integrate renewables, hydrogen, nuclear, and carbon capture to existing systems. Their deep expertise ensures safe, efficient, and sustainable solutions across the full energy value chain. Backed by the Lloyd's Register Foundation, they provide independent guidance to help businesses make confident, future-ready decisions. Learn more at lr.org/energies or connect with the Lloyd's Register team in person at an upcoming EIC event. Hello everybody, it's Stuart Broadley here from the EIC. Welcome to another very timely EIC Energy Insights podcast, which reflects on the key findings from EIC's Bankable Energies event in London earlier in 2026. Bankable Energies is a one-day event that we host every year, which brings together policymakers, regulators, operators, developers, supply chain companies, and most importantly, the investment and insurance community, so that we can have a deep dive into why it is that some projects get to final investment decision, or FID, and are seen as bankable while others do not. We look at projects that do reach FID and gain an understanding of what they did right, and we look at projects that are not yet at FID and debate what might be needed, bringing together all stakeholders into one event to get these projects bankable. We look across the whole spectrum of the renewable energy and transition environment, including offshore wind, battery energy storage systems, hydrogen, carbon capture, and of course we look at data centers, which is really a revolution in energy right now. And we all know, of course, that net zero cannot happen without getting all of these renewable and transition projects to FID. In this podcast, you will hear firstly from James Foley of Santander, then Andrew Lee of Société Générale, then a wrap-up discussion with me and EIC's Neil Golding, Kim Stephen, Becca Groundwater, and Mahmoud Habboush, as we debate what a bankable energy project really needs to look like. Enjoy. Okay, so I'm here with James Foley, who works with Santander CIB, which stands for Corporate and Investment Banking. And you are Executive Director as part of the Energy Structured Finance team. And obviously, thanks for coming along to the Bankable Energies event today and for being on a panel discussion. I just wanted to follow up on that with you to ask, in terms of the work that Santander is doing in, let's call it the green finance space. I don't know what you call it, sustainable finance space. What's your view on the different technologies and what are the different stories around each of them?
Great. Well, first of all, thank you, Stuart, and to the EIC for hosting me and many others today at Bankable Energies. It's a really great event and look forward to coming back next year. So, as you rightly said, I'm part of Santander CIB's energy structured finance business. We're actually one of the most active banks globally for financing energy and energy transition projects. I focus on project finance, and that is the lion's share, clearly, of how you need to bring capital to energy transition, as well as equity. And my colleagues in the bank are also there to raise equity and run M&A processes. To give you a bit of a feel, last year, we actually got Global Advisor of the Year award from IJ. We closed about $40 billion of debt through our advisory franchise. And we're extremely active with our balance sheet as well.
Congratulations.
Across all sectors. Thank you very much.
So you're the right person to ask then.
Well, I think it's not without a big team. We've got, I think, one of the biggest teams globally for this space, and we very much have a global model. So a lot of the learnings that we have, they're informed by what we're doing in North America, Latin America, as well as Europe and Asia. So it has to be global, particularly with the newer asset classes, where the lessons learned from one project are very much transferable to another. So I think, when you look at the UK, which a lot of discussion today has been focused on, the UK is one of the great success stories in many ways, but it's very specific to the UK. You can draw lessons, but more importantly, you can take lessons from the UK to other places. And I think that's super important. So global focus is there, and it's there for our clients ultimately. You talked about technologies. So again, to give a bit of a feel for what we do, Clearly, a lion's share of what we do is renewables. Offshore wind is the biggest by its nature. You will see this year, and indeed next year, some extremely large offshore wind farms that will come for financing. And clearly, they will also need equity to come in. It's helped by having large developers, also financial sponsors entering offshore wind more and more. But offshore wind is only one puzzle. When you bring on huge amounts of large-scale generation projects, you also need to make sure you have battery storage or indeed gas peakers or other forms of flex gen on grid. I think the most active space, I'd say in terms of number of deals rather than deal size for us at the moment, is battery storage. We've closed 60 battery financings now as Santander. We started financing batteries back in 2018. This is when we signed the first one. And the deals are just getting bigger and bigger and bigger, but also broader across different geographies. I think the largest of which that's been project financed globally is one that Santander actually advised on, which was Thorpe Marsh. It's a 1.4 gigawatt project, which was FIDRA's platform, but they brought in also National Wealth Fund, which we supported on. So some enormous projects in batteries, and we're going to see more. We may see some long duration energy storage projects coming as well.
And long duration for you would be what?
Well, long duration is for Ofgem. So under the current tender round, it's 8 hours duration plus. Clearly, you can have pumped storage, which can be a lot higher, but the minimum is 8 hours. So it's quite a step change from the short duration. There's kind of pros and cons for that, but ultimately you will see a lot of capital flowing into longer duration because of the way that the cap and floor mechanism is being structured. It's very similar to the interconnector model. And interconnectors clearly have been very well banked and they work very well for debt. You can get very attractive levels of leverage at competitive pricing. So we expect that to be used somewhat for the long duration or LDES round coming up.
Just picking up on the LDES round, are you seeing long duration energy storage as the number one priority to achieve energy security now? So it's less about building more renewable capacity, it's about better use of the renewable capacity we have through storage. And I'm not meaning to say either or, but I'm saying in terms of short-term priorities and bankability of projects, what are you seeing?
Yeah, short-term priorities is the right way to think about it. It depends how short-term we look, right? So even if you start today, you've still got a bit of a lead time to get anything operational. Not only you've got construction, but there's a tender round, there's an auction process, etc. That takes time and things change in time. But we are seeing a lot of activity clearly stimulated by that Ofgem process, and there's a real need for it because of the way the electricity production is likely to fall, right? You've got periods of lots of wind, you've got periods when effectively it's windy much longer than short duration batteries can charge. So we need some long duration. We do have pumped storage. There can be more pumped storage, which may come out of this process. And there's also other forms of technology. But long duration storage is one of the pieces of the puzzle. For energy security, you need to have the full value chain. And LDES is part of that. Short duration can do some of it. And we have a lot of short duration and we'll have more. Really grids and grid reform and gate to offers going out. That's absolutely critical to getting projects off the ground. And there are many projects which are very good, viable projects, which are still waiting for their gate to offers. So when that's unlocked, it will very much help.
I just wanted to keep pressing on the bankability issue. So let's imagine a situation where, as we've been talking about today, we're going to probably have higher interest rates through 2026 because of the Middle East crisis. We don't know yet the scale and the duration and, the severity of that, but it feels like that's an inevitability now. So that will mean that some renewable projects that, as happened after the Ukraine war, were less viable for a while because they were very sensitive to higher interest rates. And it may mean that we see the same now for perhaps some of the projects that got CFD and AR7. Perhaps that doesn't mean they may not get FID. We'll see. But do you think that long duration energy storage is somewhat protected even from a higher interest rate just because they're so much strategically more important, more bankable? The business case is better, basically.
I mean, you're solving for different problems. The supply chain in some ways is, and the construction certainly is more straightforward if you're building a long duration battery than an offshore wind farm. Now, the revenue model is heavily de-risked. You have a floor. It's de-risked in both. The LDES process, you can get a 25-year contract, which is super long term. Clearly, the CFD is now 20 years. So there's a lot of selling points clearly for both. You need both. At the moment, we don't have very much long duration, but that will come. But I think the broader market environment means that we just have to focus, whether it's for decarbonisation or energy security, we just have to focus on accelerating what we're doing. We have all the tools in the toolbox. Everybody in the market, certainly on the financing community, is ready and willing to come in and start to finance these projects. And there's a huge amount of capital which is going to have to flow in. What we do need is time periods to be shortened. So whether that's planning or whether that's grid, ultimately it's the development risk which is causing the issues in many cases, where the market, particularly the developer side of the market, really has a lot of uncertainty and has to wait. And indeed they're locking in costs, or they think they're locking in costs, which are then out of date the next month. So when there's more volatility in the market, it's much harder to lock down your economics. And that puts more risk on projects from an equity standpoint in terms of the viability. So, as lenders and generally the debt financing community, we can take some risk as a community, but there is still always got to be risk that's very much absorbed by developers. Banks are not really the best place to take that broad market risk in project financing, and there's always got to be a way of absorbing that. So if it comes to partly through the government support, that's a very important tool, but also equity will need to absorb some of that risk, and that means that returns have to adjust for it. So let's see how long the geopolitical environment continues in this way, whether it improves or deteriorates. I'm not here to speculate. There's much better experts to do that. But ultimately, the issue is not fundamentally financing. I don't think that is the issue for accelerating. It's de-risking delivery on projects and ultimately shortening time periods so you have much more confidence when you take projects through, and then the financing will be there.
So other technologies that you are excited about right now?
I'm very excited about nuclear SMR. I think small modular reactors are going to be a game changer. I can't tell you exactly when. There will be different views, different parties out there will have their own view on when they think they'll be ready. Clearly the UK is as usual, one of the pioneers, and Great British Energy Nuclear has some projects which are planned for WILFA. There are some very exciting projects in the US and so on. But that is a massive game changer as soon as we get that up and off the ground and into, clearly a financeable position, and it will get there. And we've already built on the success of, for example, closing Sizewell C, which closed last year. We were the documentation coordinator on that deal. We came in with the joint largest ticket in the transaction with our financing support. That's an enormous, enormous deal. You can't do that every time. So SMRs are still very, very big, and you still need a huge amount of capital that goes in, but they're a little bit more manageable. So once you get the first of a kind projects up and running, then I think things will get easier. And then there's massive opportunity to both increase security of supply and decarbonize, certainly in terms of bringing all that baseload power to the grid, which is not producing emissions upon generating electricity. That can have a huge impact. And it may be needed with an onset of increased demand from AI and data centers. We'll see how much of a role the UK has to play in that. But certainly there has to be a shift, because the demand side is not standing still. We're not having a net reduction in demand. We're having potentially a much larger amount of demand. And that's just due to that transition on the technology side. So the energy system is really going to come under pressure, and we need to be on the front foot there as an industry.
Which sector, which technology do you think is going to come under the most pressure in 2026 in the geopolitical situation we find ourselves?
I think that it's a difficult one to answer because first of all, I work with projects across a whole piece, and we support them all, either as an advisor or a lender. So we see the strengths in all of them. And clearly from a financier's perspective, we just want to pick the situations which are most likely to happen. So I think that's broadly the approach that we have to take. I think the pressure more comes on delivery and industry and supply chain. When you have suddenly a huge uptick in projects that have to be delivered, that puts pressure on supply chain. That means you do increase the kind of risk on delivery of any one project. But certainly that's something which I think supply chain should see as an opportunity. We just need to make sure that the government helps to enable that to happen and happen efficiently. We need consistency of policy, and certainly financing follows. Fundamentals of all of these sectors are there. In some cases, you have extremely viable projects. They're just waiting. right? And that's a big issue. It's a big issue if investors are waiting to put more capital in, but they don't have certainty on auction rounds or whatever it might be. So that's important. But fundamentally, when you have a flow of deals that are coming, the banks, they'll prepare for them, they'll get ready, and they'll be there to finance them. So I don't think there's any fundamental issue with the financing side. It's very much about having absolute certainty that there's going to be a flow of projects in a given area, and then you'll see the scale, and then you'll see the market momentum take off.
And right now, looping back to where we started, that is energy storage systems, isn't it? Battery energy storage is the most populous project group right now in the UK, across Europe, and I think increasingly around the world.
We really are seeing a lot on battery storage. And I think the UK has been, well, I'd say it's at the mature end of the market. I mean, it's not done by any means, but it's certainly more mature than a lot of the European markets. I think everybody's looking now at Germany. You know, Germany has a huge need for BESS, and you have some very large projects planned. And there will be a significant number of projects which come through in the next couple of years. And the one which probably needs it even more is Spain. Clearly, Santander, our history is very much as a Spanish bank. We're very much now a global bank, but we're still Spanish. And Spanish batteries, that has to be a key focus for everyone. We're seeing a lot of progress in Italy. We're seeing a lot of progress in Netherlands, Belgium, Poland, France, Nordics. It's all happening. I think Spain's probably the furthest behind versus the need. And that's where we're going to see a huge amount of activity, not least because of the amount of solar power you have in Spain. You need to balance that with storage. So more likely to be shorter duration, but certainly something where there's going to be a lot of activity.
Yeah, and just a conversation I've just had over lunch here at Bankable Energies is people saying with the current conflicts happening in the Middle East, people are rebooking holidays in Spain instead of Dubai right now, which is, you know, it's not a nice reason to do that, but Spain will just need even more power, seemingly, in the future.
Well, perhaps maybe all of the Brits choose to retire to Spain. I thought they were already doing that, but
the problem is getting taxed on their homes.
Well, that's true. That's true. Well, they can come to Santander for a mortgage, but certainly the market is power hungry, and it should be low carbon power, and it should be low carbon energy also for industry. And it's even more important now to ensure that we do that from a security supply perspective, that the fundamentals are the same as they were before a few weeks ago. The costs are there, inflationary pressures may be there, rates are where they are, and people spend a lot of time developing projects. And sometimes, you know, they're not the right projects, but very often even the right projects, they just don't have quite the support from the entire system to get over the line and get to the point where banks like us can finance them. So I think there's a lot more to be done to make planning efficient, grid efficient, in terms of giving out grid connections, but also that requires investment. It requires a policy direction.
Well said. James, lovely to see you. Thank you for your time. I better let you get back to the event. Thank you.
Thank you very much.
If you're enjoying this podcast and think you have an inspiring story to tell, contact me, Stuart Broadley, directly, as I would love to do a C-level podcast with you too. EIC is proud to be the UK's largest membership energy trade association and the 5th largest in the world. We are unique around the world for 3 reasons. We are truly energy agnostic, believing all energy technologies are vital to delivering energy security, affordability and a just transition. We are the only energy trade association anywhere in the world that offers a truly in-house one-stop shop for market intelligence, networks and events to help our members export, diversify and grow. And we are proud to be the voice of the energy supply chain, advocating for the 5 golden rules of a healthy energy supply chain. More details on EIC membership, the 5 golden rules, details about doing a future podcast with me, and how to contact us about anything else are in the description for this podcast. So I'm here with Andrew Lee, who is a managing director in the Energy Plus group of Société Générale, Corporate and Investment Banking. Hi, Andrew. How are you doing?
Yeah, fine. Thank you.
Thanks for coming along and speaking at the Bankable Energies event this week. I just wanted to pick your brains a bit on some of the things you talked about today. And let's start with what you're regarding right now as the top investable sectors that you're working in.
So within the energy transition, we like to think we're involved in all of the sectors. So we're a big lender to offshore wind. We advise a large UK project, floating offshore wind project. We're very positive about that. We finance solar projects. We were the financial advisor and one of the main lenders to Net Zero Teesside NEP, large carbon capture project in the UK. We are the financial advisor to EETH Hydrogen, which is part of the Northwest Cluster. We've just, I think this week, project that we are a lender to, small hydrogen project in West Wales that reached FID this week. And that's just in the UK. So I think we're excited, we're interested in all sectors. The question is really finding the projects that are bankable and that have a reasonable prospect of getting to FID in a reasonable time frame. Because what we're seeing is that project timelines are being extended, and that's difficult. That's difficult for the projects, and that's difficult for us because we end up with resources committed for a long time, meaning that then we're not available for projects that perhaps would be a better use of our resources.
Yeah, it's one of the things you talked about on the panel was that it's not a case of whether you're willing to take on risk. It's about understanding the risk and it's about the timing of the risk. Could you explain that a bit more?
Yes, so when lending to projects, we have to present the project to an internal risk committee, as all banks do, and they have pretty strict criteria as to the degree of risk we can take. And the first part of that is actually understanding the risk. So no bank can take risk it doesn't understand. And traditionally, a lot of the risks were underpinned by, shall we say, a small number of project parties. So perhaps an EPC contractor who would build the whole project for a fixed price on a date certain schedule and give some performance guarantees. Well, the contractors have become more risk averse due to challenges in the supply chain. So we're not seeing EPC contractors willing to take that degree of risk. We're seeing projects with multiple contracts. We're seeing hybrid contracting strategies with portions of fixed price, portions of perhaps risk reward, target price type arrangements, particularly for construction. We're not seeing contractors prepared to underwrite performance risk on a lot of new technologies. So the performance risk is partly perhaps covered by the technology provider, but is not then underwritten by the contractor. So we end up with a much more fragmented, disaggregated contracting strategy and delivery strategy, which requires a much more granular assessment of the risks, who is underwriting which risks, to what degree. And the point being that banks need to understand the overall risk sort of matrix, and they have to understand the residual risk that they are being asked to take. And that's difficult if it's not clear which parties are taking which risks and to what degree.
One of the things you talked about in terms of where you are seeing markets moving at the moment is this trend towards data centers. So in a minute, I'd like to talk to you about the markets that are most attractive for data centers, perhaps around the world. But let's start here in the UK. Is the UK right now attracting a lot of interest from the capital markets point of view and from the lender's point of view around data centers, or is it seen as quite an expensive market?
I'm not that sure the current activity in the UK. What we are seeing, and a lot of trends start in the US, we are seeing a big shift in the US and quite unexpected in terms of some of the technology mixes. What's becoming clear is that the US has some of the same problems that Europe has in terms of grid connectivity. So if you want to build a very large data center, you have to find a location with power available and a grid connection available. And that grid connection needs to be reliable, uninterruptible, because data center operators are maybe not, well, they are interested in price, but price is not necessarily the overriding concern. It's availability and reliability. So what we're seeing is that projects are either developing their own power generation assets or at least supplementing the grid capacity available to them with additional generation or backup. So we're seeing projects with their own gas turbines and probably a mix of industrial turbines and aeroderivative because of the different speeds of response, but also this emergence of fuel cells, but not, as was expected a few years ago, powered on hydrogen, but actually running on methane, probably initially unabated, but the exhaust, the fuel cell running on methane, is actually predominantly CO2 with some carbon monoxide and is relatively easy to capture. So one of the major suppliers actually offers a bolt-on carbon capture facility with its fuel cells. And the fuel cells running on methane are reputedly pretty high efficiency, up at the 60% plus, so comparable to a gas turbine, but give an instant response, and in combination with gas turbines can give you a high availability solution, which is effectively off-grid. And the point being that it's maybe easier, particularly in the US, to secure a gas connection than it is a grid connection, electrical grid connection. And the same might apply in Europe in a lot of locations where grid constraints are a major issue.
It's funny, isn't it, how we spend a lot of time in the sort of bankable energy space talking about how we need better policies and we need subsidies, we need regulation, we need access to grids. But in the data center world, we don't have time, as if you were a data center developer, a hyperscaler, for all of that to get lined up. So they're having to find alternative ways and funding it and innovating in those areas themselves. And that's becoming a very attractive series of technologies and investable options for companies like yours. So, and I know companies like Bloom Energy are just seeing the benefits. And these are companies that you would argue without data centers would not be seeing the kind of growth they are today, because the regulation and the technology challenges and the sort of the off-takers in the old model just weren't going fast enough for them. How things have changed. And it doesn't need policymakers and it doesn't need subsidies.
No, and it's really quite, people will tell you they saw it coming, but I don't think people saw the rapid
We'd all be
growth.
millionaires if we saw it coming, wouldn't we?
That's right. And I think the fundamental point is with the data centers, they're self-sustaining economically. The economic model is based on the value of the data center to effectively an off-taker, if you like, a Google or a Meta or whoever will utilize it. They don't require government support mechanisms. They don't require subsidies. They just require the availability of power. And obviously, the power price feeds into the economics. But my understanding is it's not critical. It's really, and particularly in certain locations where there are strict regulation on the addition of data centers and the need that the power is additional to the current energy mix, it's the availability of power rather than the cost. Of course, that you need approvals to build and all the permitting, but you're not reliant on negotiation of a government support mechanism. And that's why the projects are moving so quickly, or can move so quickly.
So I guess just to wrap up here, because I know you're in demand down there in the networking area, what do you see right now as the technologies that are harder to get the financial case for right now?
I don't think it's really about technologies. It's about the development risk, the execution risk, and the operating risk. And it's interesting how 2 or 3 years ago there was a debate on with electrolyzers. Do you stick with alkaline as more tried and trusted, or do you take a risk with PEM, which is perhaps higher performance, more dynamic, but is a risk? That discussion seems to have evaporated. There's an acceptance of PEM despite limited deployment, and it's much more about delivering the project, operating the project, and the sort of, if not the guarantees, then at least the calibration of the operating uncertainties, really to have confidence in the economic performance. And there's almost an assumption that the companies that are in the market, they can deliver you equipment that will work. It's more about the normal, I would say, project considerations of how will it be built, what will it cost, what is the schedule, certainty, uncertainty, and what ultimately will be the long-term operating performance and long-term operating costs. So the question isn't about the technology, it's really about the fundamentals of the project.
You sound positive about green hydrogen, so the electrolyzer-driven hydrogen technologies, the projects that are coming up, and you've got involvement in many of them already.
Yes, positive, but there are still headwinds because projects require government support. And those support regimes are still sort of under development or are maturing. In Europe, there will be development on the back of the RFNBO rollout, but that is very much country by country and requires country by country legislation and implementation, and that creates uncertainty. And if those projects are going to be built with various credits that are tradable, etc., then it adds another complexity in terms of the markets for those certificates. The early projects, are faced with effectively an additional market uncertainty until that market actually develops and is more predictable.
And just finishing off, just as a stat for people listening into this, Ireland is a brilliant example of a market that's taking advantage of data centers. In 2025, I don't know whether you know this, Andrew, 25% of their complete power usage went to powering data centers. Quite incredible. With that, Andrew, thank you so much. Lovely to see you. I'll let you go back and return to the networking. Thanks again.
Yeah, thanks a lot.
Are you an energy business looking to revisit your strategy? Did you know EIC's Consult team helped 50 businesses last year? How? We helped them with their strategic investment decisions using EIC's award-winning market intelligence and data to provide them with tailored, pragmatic BD strategies, presentations, and reports. It works. Our data and insights have helped customers to confirm their decisions to export, diversify, and grow. Contact us now to learn more about EIC Consult and begin your own journey to smarter decisions. Details in the description below.
Okay, well, we're all somewhat exhausted after another Bankable Energies event here in London, but I think it was a great success. So let's, Neil, perhaps if you can, you did a very nice wrap-up at the end of the day.
Yeah, I agree, Stuart. It's been a great day, and I think it was really helped by our keynote, Neil McDermott, the CEO of LCCC. That kind of gave us that view of the current state of the UK market, the importance of predictable revenue frameworks, and he also highlighted the learnings from the recent allocation rounds. And what has been clear throughout the day is the importance of the CFDs, the RAB model, or revenue certainty mechanisms, as the enabler for developers and financial institutions to move forward with many of these clean tech projects. With regards to CFDs specifically, the reason investors like them and developers like them is very much a case that they're predictable and they're very well understood. However, I think it was Close Brothers that mentioned it would be really helpful if we could have greater visibility of the future pipeline of the allocation round. So yes, we got AR8 coming out, but what about AR9 and AR10? Getting a visibility of that pipeline may help speed up the pace of the transition. There are other key themes as well that came out. Political support and stability, that's absolutely needed for developers, investors, and supply chains. I also felt the grid, I can't recall a session where the grid wasn't mentioned, and the importance of more investment in the grid, availability of the grid, in ensuring that these developments do move forward. It was actually really pleasing to hear as well that there is a positive feeling about the UK from the investor market, one of the top 3 markets for one of the banks that was presenting to us. And so that attractive place to do business is not always what we hear. Also, it's one of the first sessions for some time where I've heard real positive feedback on the potential for hydrogen. And that's really a bit of a sea change, I think, in terms of what we've been hearing and in terms of seeing, in terms of the final investment decisions that have been made.
That was stark because we've got Gregoria here from Belgium saying how different that is from what it feels like in Belgium and the Netherlands, where they're really struggling to get going with hydrogen. So yeah, I think you're right. That really stuck out, didn't it?
Yeah, absolutely. Really, there has to be a coordinated approach to everything that we're doing, and early actions that involve developers, off-takers, government, financiers, and also the supply chain. What became as well fairly obvious in terms of one of the themes is that first of a kind is a bit of a challenge for investors. It's kind of what we've always seen. It's the race to be second. What investors like is scalability and repeatability. That then gives them the certainty of delivery. I really enjoyed the session on the risks and how those risks need to be shared by all participants within project developments. And then pace, that's absolutely needed right now to ensure that not only are our targets met, but to also ensure that the banks don't lose interest. The money doesn't run out in the DevEx phase. That struck home as being quite stark reality, and I think we'll come to something a little bit later around feed fatigue. And that ensuring that costs don't rise. More delays leads to increase in costs, materials increasing, and right now supply chain vulnerabilities as well, the longer that we delay these projects. But there are numerous reasons to be positive, and I think that came out in the final session where Equinor, EDF, and Copenhagen Infrastructure Partners all talked about big projects that have reached financial close very recently. Not only that, there was positivity around the energy transition sectors from financiers, and that should really be a sign of encouragement for all interested parties in terms of projects of the future. So I think it's, again, positive signs for the UK market.
I think, as often happens with sessions, the morning felt a bit harder because everybody was getting through what seemed to be all the difficulties of bankability. But then as the day progressed, it moved into, but if you follow the money and if we get organized, there's a lot of opportunities as well. So I think at the end of the day, everybody felt much more positive, actually, didn't they? About, okay, there's actually a lot of opportunity, a lot of things to go after here. Okay, great. So the other thing we did today, as well as run an event, is we launched our inaugural Bankable Energies event. So Mahmoud, you are report author of the new Bankable Energies report. And you've done all the work, did all the interviews, did all of the write-up and research. So firstly, thank you for doing all of that, because that was a lot of work, adding to your day job. But I was really struck by two of the findings from the report that I think it'd be good for you to just talk through. One of them was this idea of feed fatigue, which I hadn't heard explained so clearly as you picked out in the report. Can you explain kind of what people were saying about that?
Yeah. Thanks, Stuart. That's definitely something that kept coming again and again during the interviews, the 50 interviews that we've done for the report. When we talk about feed fatigue, what we really refer to is the fact that there is within the energy industry plenty of projects that are in development stage, that are in feed or pre-feed stages. A lot of work, a lot of studies, a lot of paperwork and designs. But that when we talk about conversion into FID, into final investment decision, into these projects, paper projects becoming actually bankable and then, of course, buildable, the rates aren't great. I know Neil, of course, gave some silver linings this morning about, I think it was hydrogen and other sectors that are picking up there. But even then, that rate isn't as good or isn't as anywhere near where it needs to be when it comes to meeting government targets for these sectors. So that's really the crux, if you will, of feed fatigue. What is the cause of that? I mean, I drilled down into this and I spoke to them, different people around that. And the reasons are different depending on who you talk to, whether it's a banker or whether it's a supply chain company. But we can really boil it down to lack of robust, of benign offtake agreements that can stand the test of time. There are risk issues where who carries the risk and different parties trying to move the risk to one party or another. And there are, of course, issues related to permitting, to licensing, to getting connected to the grid. One last point about feed fatigue that I'd like to make here, which is very important, I believe, and certainly everyone I spoke to believes in that. The supply chain just doesn't mean if there's no work coming to the supply chain will just sit and relax. That means the supply chain will be in a very dire situation because they will be looking for work either elsewhere in a different sector or sometimes in a different geography. Basically, the supply chain cannot stand still. If it does, it means it will end, it will die out. So that's why there's that call. I think Neil mentioned the issue of timing and moving things quickly. That's why it's extremely important to move things quickly to prevent the supply chain from dying out or moving elsewhere. And of course, with the supply chain, we're talking about skills.
Yeah, so feed fatigue, I think, really came home to me as something I'm going to remember a lot. There's another thing, though, that also came out of the report. It just rolls off the tongue, which is this idea of how can we're talking here about UK energy policy, and this is really what the exam question was, and how can energy policy be so good and so bad all at the same time? This idea of being so good and so bad all at the same time. It sort of kind of makes sense, but you got that very clearly from the messages you got from the interviews. Can you explain what that means?
Yeah, it's a simple thing, and it doesn't matter whether you talk to clean tech companies or oil and gas companies or companies who are active in both. And the idea is when the government is working, when it's providing practical solutions, and the biggest standout in this regard is CFD, contract for difference. These are hugely important contracts that allow investor to come into hard to invest and otherwise hard to invest project because the government guarantees a certain price. The government basically compensate the operator if the strike price goes down. And this is hugely important for bankability. When you go to a bank or a consortium of banks with such a contract, it's a done deal. That's basically a gold standard of when it comes to getting any project bankable. So that's when the government is working. It can also be working when it serves as a backstop, for example, providing termination compensation, for example, or carrying the risk in multi-party projects where a certain part of the project is falling apart and nobody is willing to carry that bit of risk. Then again, when the government comes and carry that bit of risk, it's hugely important. That's when the project moves from potentially a non-project from the banks or the finance from the funders' perspective into a fundable, a financeable, and definitely bankable project.
So these are the examples of when the policy is really so good.
Exactly.
And yet the same overall policy you're hearing can be so bad.
Exactly.
And why is that?
The main reason, if we really want to boil it down to three things, I suppose, the one most repeated probably one is the fact that there's policy uncertainty. And that's, to be honest, to me, I think to all of us is not news because we've been hearing from the supply chain for at least the past 3 to 4 years. So that's one important thing that is standing in the way of getting projects, again, from concept to build. The other thing or two things is licensing and the speed of licensing and also the speed of connecting to the grid. So these three things together make the government in many ways an impediment to bankability. If we look at these things and what we're seeing, the government can really push things really hard in magical ways, but they also can hold things to a standstill.
I used to have a boss, I'm going to say his name, Sir Ian Wood, the boss of Wood Group, and he always used to say famously that he likes to run a business where he's got one foot on the accelerator and one foot on the brake all the time. And as a little bit then, I think what this is saying, which is somehow the policy's so good and so bad, it's like we're accelerating but always with a foot on the brake, and so it's never quite achieving what it could do. So I think that's a nice point. And what actually, I wondered whether part of the feedback you were going to get was also just this frustration about not supporting oil and gas. But I think that you're right. It's an issue of the developers who are benefiting and supporting and believing in renewables just want to go faster and want more surety. There is a broad view from many that they would also like to see oil and gas policies renewed and EPL reduced or removed. But that's not the point you're making. So I think that's very helpful. So thank you, Mahmoud. Thanks again. And enjoy your rest before we start the next one very soon, because we definitely need to do another one.
Absolutely.
Kim, so obviously you're running the UK and Ireland region.
Yes.
But you represent a lot of our members. Obviously, we're a global organisation, but the biggest community of our members is still in the UK. What do you think they got from an event like Bankable Energies, and what are they looking for?
Yep, you're right, Stuart. So as a global organisation, we have that wider remit, but I personally have a vested interest in the UK market specifically, as do our UK-based members. And we want that to continue to be a strong and sustainable market here in the UK for our members that are operating here. But we do hear increasingly that they have an export sort of focus in order to kind of balance their work whilst they are looking to fill their order books. As Mahmoud says, they are commercial organisations. But I'm buoyed by the fact that at the event we did hear sort of positive news about the UK market, and it does remain strong. And I think to your point on what are the UK members and our membership in the supply chain, and what are they looking for, what are they needing, I think today at the event we took away from very much the fact that bankability is as much about confidence as it is about the numbers. So whilst the finance and investment community are working with the developers to build those relationships and sort of increase that track record for that sort of repeatability and scalability that Neil touched on, members want that visibility so that they have that confidence in the pipeline. There's lots of C's flying around today with our LCCC starting off with the kind of keynote. I think for me, as Mahmoud said, consistency of policies is key to give us that certainty of revenues. Everybody spoke to that certainty piece that they were keen for. It is complex in the nature that there are a lot of different parties.
Are you doing
involved.
this on purpose now?
Deliberately,
Yeah.
no. Just by chance, I should say that it's come out in this way.
Chance. You're doing well, Kip. Yeah.
Sorry. But it will require collaboration to get to that point.
Genius.
I should say that I think as part of EIC's role to kind of develop that.
You're working on your next one as well, aren't you?
Continue the conversation in terms of raising these important issues as part of kind of our...
A chorus of...
I wasn't going to add that one, but I could. It's like, I guess we understand what's important to
We're still having
members.
fun is the point.
Indeed. But it's making sure that we keep that sort of conversation flowing. Last year was the inaugural Bankable Energies Conference. This is year 2. So we've continued that development of the content in this sort of important topic, bringing these different groups together. And developed a series of roundtables as a result and working with our partner Lloyds Register through last year into 2026. And I think for us, making sure that we continue that conversation will be vital on behalf of our members. But yes, buoyed by the fact that it was a positive discussion today and that there is sort of a positive nature from the investment community about the UK market. And let's see where the next event takes us.
I agree. It was a very positive event in a time, but I mean, here we are now, with war in the Middle East. So there was definitely a view, which is where are we going to go with an event like this, given what's happening right now? And I guess when this podcast is published, I don't know what will happen in terms of what will be the situation at the time. But we've all got colleagues and friends and family and others that live out there and work out there. So I wasn't sure quite how people were going to take today, where we're really asking some of the most difficult questions about policy and trade and collaboration and investment. But as you say, it was a very positive outcome. And I think the spirit of industry and policymakers and finance and insurers that were all here today was, firstly, there's opportunity everywhere you look. And, these kind of challenges also provide opportunities, but also we're used to somehow these sorts of uncertainties. And somehow we've become very resilient. I guess finally, Becca, you moderated 2 of our sessions today. You've been leading our Voice of the Energy Supply Chain work for the last 5 years now. How did you find today and what did you take from it, and kind of how do we now move forward with this sort of still very raw messaging we're getting? It's hard yet to say it's shaped into here's 3 clear asks of policymakers and here are the clear opportunities for investment. It's still very much a moving target, I think. What did you take from today and how do we move it into the next phase?
I would agree with that statement. I'm not sure it's a moving target. I think that it covers everybody in the entirety of the sector, but each of their needs are different depending on where they sit. And it's trying to, what we've continually talked about is the siloed approach of government, but also in the industry itself. So the needs of the developers are very different to the needs of the financiers, which is very different to tier 2, which is then very different to tier 3. Trying to pull that together is really tricky in how that then plays out. So there are certain issues that are across the board. And I think what I heard from everybody today, from the investors and the banks to the developers, and that we've heard from the supply chain, is that the visibility of that pipeline and having that conversation around what the timelines actually are is so important to absolutely everybody. This isn't just one part, this is everybody. So having started with it's too siloed, actually, it comes back to the visibility and the honesty of those discussions. So I think the silo piece is interesting, not just industry. Like Mahmoud said, we had various robust offtake agreements, the movement of the risk. Maybe we need to be a bit more honest ourselves on, right, okay, to actually get this across the line, let's get these players in the room and discuss honestly what needs to shift, what needs to happen, who is taking responsibility. In terms of the government, the licensing, the grid policy, again, we heard today that the ghost projects are potentially coming off, and it might not go to unlock room, but it will clean it up.
The grid application process is
so
the way.
Companies who perhaps put bids in or requests in that now don't need them, but they're still in the system, that cleanup of the whole energy discussion, I think, would be really beneficial throughout the sector.
And that's an example of how this government They are actually being as aggressive and ambitious as they feel they can be to try and get rid of the roadblocks.
Yes. And I think this is one of those things that sort of goes under the radar unless you're actively involved in the grid or unless you're one of those key players. There is a lot that's happening. It's just not the big headline grabbing stuff that typically the politicians are chasing. And again, we heard that today. And I think this is where the Directorate of Energy Supply Chain comes in, which is bringing together a cohort of people who don't necessarily engage with each other on a regular basis and getting them in the room and saying, okay, you may sit in very different places, but what are the points we can agree on? And again, it's that local content, it's the visibility of the pipeline, it's how to drive that forward. So it's working with everybody around the table, with the report, with Kim and with Neil, and looking at the data, looking at our members' feedback and the stats and the data to say, okay, this is what is across the board with everybody. This is what we're going to get after. We've had our first meeting. There will be 2 or 3 points that need to come out of that. We've already had feedback from a number of attendees, and I'm confident that with this, with the other events in the UK, the Energy 360 Summit and also the roundtables, I think that we're in a good place to actually start shifting the dial in a way that is energy agnostic and in the best for our members and the energy discussion as a whole.
Very good. I just want to say thank you personally to all of you. And of course, for the whole team behind the scenes that does an event like this. It's a lot of work. Now we can relax. Thank you. Well, that's our show for today. A huge shout out to Samara, Lucas and Joao and the rest of our incredible team behind the scenes. This show truly wouldn't happen without them. If you enjoyed this podcast, it would mean the world if you'd hit that follow button, give a 5-star rating or leave a review. It's the best way to help us keep doing what we love. And as a thank you, I'll leave you with my favourite 5-word joke. Love wind power. Big fan.